Good Monday morning, Market Chameleons. Everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dmitry Pargamat. How you doing, D?
Good morning, Will. How are you?
Good. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Alrighty.
With that, let me share my screen. As I'm doing this and sharing my screen, for anyone joining us for the first time, Will and I, we do this show in the morning to try to help answer questions you may have about Market Chameleon tools, data, or the analytics. If you have a question, type it into that live chat on YouTube. We're reading it, or Will's reading it. He'll let me know, read them back to me. If you want to come on a show and ask your question live, we also provide a link to Zoom. So click on that link once you're in Zoom, click raise your hand. That lets us know you have a question. Then we'll let you in. You could ask your question live and direct. And just to take a couple minutes and give you guys a chance to put in your questions, what we'll do is start out taking a look at the pre-market report, see if we could get insights on what's going on in the pre-market hours, and then we'll move on to the questions. All right.
Perfect.
So, yep, pre-market, these are stocks that are trading in pre-market hours. Here at the top, we have this calendar view that if you click on it, goes back in history, see what happened in a pre-market hours on that date. Now we're on November 1st. This is what's going on so far from the high level. We have 357 stocks trading higher in the pre-market hours, 289 stocks trading lower. As far as volume goes, we got 98.7 million shares traded on up volume versus 33.3 million on down volume. And if we convert that volume to dollar value, we got $1.9 billion worth of stock trading on up volume versus $873 million stock trading lower. So that indicates so far the trading in a pre-market hours looks like, they're trading with some bullish sentiment. Okay, let's look at it from a couple more perspectives, then we'll move on to the questions. I'm going to come down here, and here we have three tables. We have our most active stocks in the pre-market hours, got our biggest percentage gainers and the biggest percentage decliners. I see 32 stocks made our percentage gainers list, 43 on the decliners. So from that perspective, looks like maybe slightly bearish bias in the pre-market. However, if we look at this list, there are stocks in there. We have low cap stocks, ETFs, leverage products, could be inverse ETFs, closed-end funds, pretty much any security listed on a major U.S. exchange, if it's trading in pre-market hours and it meets our liquidity thresholds, which is important because we do have thresholds in there, it can make this list. And to narrow down to a smaller group of stocks, we can use the filters here above. If you have a watch list, you can filter by your watch list. We're going to use this in ETF filter. When you click on it, get a drop-down menu to select from. You got broad-based ETFs, you have sector ETFs. Let's click on this one, SPY. That's the S&P 500 ETF. And these are the SPY holdings, right? So this filters by the stocks that are holdings in the ETF, which in this case are the S&P 500 constituents. And here we have 7 stocks that are trading higher, made our percentage gainers list. Sorry, so this has to make our percentage gainers list, and 9 on our biggest percentage decliners list. So that also indicates, a mixed bag, maybe slightly bearish. So, mixed signals here. Some Some up top here, indicate more bullish sentiment here, maybe slightly bearish sentiment. So a mixed bag. But we gave it a couple minutes. Will, if you have questions, I'll take them now.
We did have a question, D, from a first timer to the Chameleon morning show. It's from Fred.
Yep.
So welcome, Fred. Thanks for stopping by, and thanks for the question. He says, Fred says, I have already picked a stock that I want to write, and I am a seller of Volatility. How can I use your platform to screen for the optimum strike and expiration? Many thanks, guys. That was the question from Fred.
Okay, thanks. So it looks like the question is how to screen for potential buy rights in a particular stock that you already probably own, right? I think that's the question. Which we could go, I guess let's go to the screener here. And here we have covered calls. So a couple things, and I think he said that he has an optimal, he already has a stock, right? A particular stock. So this is the covered call screener, and it starts out, it defaults to an expiration, I think the next monthly, but you could change that up here. So let's assume you want to look for something in the next 30 days, something that expires in the next 30 days. And without using these other filters, what we could do is, let's say you picked out a stock, SPY. Okay, so I'm going to do an SPY only because I think he did say, right, he already has a stock in mind. So we're going to narrow it down to a single stock right here, SPY. And then we get all these different SPY options, right? So over here, you could see I have like 20 pages already of different SPY options. And there'll be different expirations in here. So you could see here, I set that, show me all the expirations that expire within the next 30 days. So it could be, tomorrow, weekly, or whatever, right? So all these expirations within next 30 days. And, so this gives you days to expiration over here. Okay. Then you got different strikes over here. As you could see, these are the call bids. So we're just going to reference the call bids at this time. All right. Hopefully you could do better than that, but that's the analysis. We need a price, so we're going to reference the call bid. These are the deltas. Okay, and this is how far away the strike is from the spot price. So you could see here, now we bring back all this data, right, to analyze. So when we talk about optimal, really, some of it is going to be based also on your outlook, right? If you own a stock and you think my outlook is, that the stock will not go above this certain strike, or they'll stay in between this, whatever, then it makes it much easier to pick an option. Because some people like to sell in the money options, some people like to sell at the money options, some people sell out of the money options. So it's going to, ultimately the optimal strike will be your outlook. Okay, but this data will kind of give us more insights on historically how things perform, right? So that's what this is. You might have an outlook, I want to sell out of the money, that's fine, or in the money. I have heard people like they only like to sell in the money options and then close them out, whatever, that gives them more protection to the downside. So when we're looking at it here, right now, we could just analyze these options from a couple different perspectives. We could see here the implied volatility rank of these particular options. So this is going back in the database and saying, okay, find me historically an option, in SPY that has a similar days to expiration with equivalent distance from the spot price, right? So it's looking at similar options historically. Tells it retrieve the implied volatilities for those options and show me the IV rank. So this is saying here that historically, the implied volatility of similar option, 56% of the observations were below the current implied vol. All right, so if we're taking the IV of this option right now, 56% of similar options were below. Okay, so it's going back in the database, which is very intensive because you could imagine here, every option is different, right? This option is different from this option. This option is different from this option because it could be different days to expiration. It could be different strikes, or some are in the money, some are out of the money. So we're trying to go in there and really figure out, well, what is an option historically that looks similar to this, what is the IV rank? So that's what you have over here. Then we give you a couple more stats to look at and say, okay, if you're doing the buy right, so why do some people do the buy right? Well, some people do the buy right because they want to see, well, how much downside cushion does it provide me if I write it, right? So one of the reasons, like, okay, well, I'm doing the buy right because if the stock falls, I collected some premium. So where would be my break even? How much, to the downside? How much cushion does it provide me? So that's what this is, 2.2%, 2.1%. So you can see, so in the money option, obviously will give you more downside cushion, right? That's what it will give you. If you have an at the money or an out of the money, it'll give you less. But this quickly just provides you with the reference. So then going next to that, the next thing you want to know is, okay, well, how much time premium, right, do I have in this option? So with, 22 days to go, how much premium over parity, right? So this is time premium. So you could have an in the money option that could be $10 worth $10, but a lot of it could be intrinsic value. So maybe only 50 cents of that is actually time premium, right? So you could have a really deep in the money option. And if you sell it for $10, that doesn't mean you have $10 in premium over parity. If it's $9.50 in the money, right, then only half a dollar is premium over parity. Okay, so this is looking at time premium, the premium over parity. So that's what this is showing you here. So if you have a deep in the money option, it could provide you, like over here, it provides you with more downside cushion, but the premium over parity is less, right? So here, for example, if you write, here's a 415 strike, right? Well, the stock is 418.37, right? So it's already $3.37 in the money. So even though, you sell this call for 11, well, not all of that 11 is time premium because it's already in the money by, over $3.37. So this is showing you 2.7% downside cushion, but premium over parity, 1.9%. All right. Now, next to that, this is just showing you, well, if the stock at expiration closes at this price, exactly this price, what is your, what is the return above, what is the premium return above the spot price? So that's what this is, 1.9%. Right. So again, right now, we're looking at the different analytics to help us make those decisions. All right. So we have these to quickly reference, and of course you could use filters, right, to narrow these down. But let's keep going for now. So what does this do over here? And this looks at historically, because when people do a covered call, they don't. It's just, that's a strategy, right? That's just, people just do that strategy. So it's looking at the strategy of a covered call. If you did a covered call strategy continuously, right? It didn't matter if the option was in a low implied volatility or high implied volatility or median implied volatility. Right now, just saying, if you just did this, you just used this as a strategy. And if it went back into the database and said, and you use this particular option characteristics, right? So what you did was you only did an option that was 22 days to expiration, that was, this distance from the spot price. So it shared the same characteristics, right? Same parameters. And you did this strategy and you reset it every time. So, it would expire, then you would find another, we would go see, like, as soon as we found another option that met these similar characteristics, we did it again, right? Go back in a database and find those observations. All right, that's what it's doing. Going back to the database and running, it's basically running a backtest for each one of these. All right, that's how, like, just like right here, you're doing that in a screener. The screener is already running a backtest on each of these options for you. And then it's saying, okay, we found 517 observations, that met this criteria. And if that covered call, if you did it historically, just over and over, 77.4% of those ended up being profitable at expiration, right? So if you did this, held it to expiration, 77.4 of them were profitable. Obviously the other 22% were not profitable. Okay. And then it said, all right, take the profits and the losses, right? If you did it all 517 times, take all the profits, take all the losses, and give me what was the average on average. Was each one, was it profitable or unprofitable? So on average, the return was 0.3%, per trade, basically. But keep in mind, that's taking the wins and the losses, averaging them out to say, well, if I reset this each time, basically I did the same notional risk, right? So every time I did the same notional risk, and did it over and over again, then over the long term, it was a 0.3% return. Okay. So how does that compare if at that same time, right? When I reset, if I at each moment, right, I would have to reset it to a different strategy, because this option expires. That means I would have had to go and then reset the bet and do it with a different option, and kept the same notional risk. So remember, keep in mind that this return means that at each starting point you did it, that your risk was equivalent. Okay, so what if we compared that to say, at that moment, right? If I separated it and said, well, what if I just did the stock and forgot about the option, right? So at each reset, I'm going to separate it and say, well, what if I just did the stock? Without the option, would have it been better? Would have I been better off? So right next to that, we give you a comparison backtest. So what this is saying is the following, that the percentage of times it was profitable declined, right? So you went from 77.4 to a 65.4% return. I'm sorry, profitability. So the frequency of times that this was profitable went down, because obviously, look, if the stock goes down here, also kind of makes sense, right? Because if the stock goes down a little bit, well, this could still be profitable, right? Because you still have a cushion, right? So you still have room here that a buy rate could still be profitable if the stock goes down. Like say the stock went down even 1% here, well, this buy rate could still end up being profitable. But if you just own the stock, it would not have been, right? So we could see here that the frequency of profitability went down from 77.4 here to 65.4. However, at the same time, what do we know? Well, on the upside, when you're doing a buy rate, you're capped, right? So if you bought the stock and you sold this call, right? So yes, you bought the stock for 1837, you sold the 416 call for 1050. Well, if the stock goes to, 450, well, you're capped to the upside because you're going to get called away at 416. You got the 1050, you got $10.50. So you're capped to the upside at 1.9. So what we want to do is measure, okay, so we realize, yeah, we have less wins, but the times that we do win, the times that the stock goes up, well, the return could be greater if we just held the stock without doing the buy rate. So we need to compare that too, right? We need to compare, well, maybe just holding the stock would have been better off, not even doing it. Even though the amount of times, that those wins went down. So here we're comparing and saying, yes, on average, okay, if we reset at every reset, right, these 517 times, instead of doing the buy rate, right, we just reset the amount of, the notional value of our risk, right? What would be the average return? So let me explain what a reset is, right? A reset is saying that at each moment, right, at each of these moments, that whatever stock I own, I would reset it to that I'm only risking $1,000 worth of stock. All right. So in dollar terms, what do I have at risk in dollar terms? So if the stock went up and I own 1,000 and the stock value of my holdings is 1,200, I would have to sell $200 worth of stock to make my risk back at 1,000. If the stock went down and I only own $800 worth of stock, I'd have to buy an extra $200 worth of stock. Okay. So at every reset, right, if we just did the stock, forget about the option, I'm going to compare these two strategies and I'll say, I know that, yeah, I'm going to have less winners, right? That means that I'm not going to be profitable as many times. But if my end goal is to have more money at the end, right? If that's my end goal, just at the end of the day, I just want to have more money, right? Even though might have less losses, I want to see my average return, right? Is that my end goal? Is my end goal just to have, from this time I started to the time I ended, I just want to have a bigger pot, even if I take it on the extra volatility and extra, risk of up and down. So what this is saying is that the average return per trade was 0.8%. So you could see here that over here, right, what you're doing is saying, yes, I'm willing to take on more losses. I'll have the frequency of losses will be greater, but at the end, the return, right, because I took on that extra volatility, my return exceeded this. So you're talking about, more than 2 times, right? For all these 517, here on average, 0.3% versus 0.8. All right, so that's how we're trying to compare from a historical perspective, how the buy rate strategy did, and then we compared that, right, to another benchmark. Well, what if we didn't do the buy rate? Like, what did the buy rate strategy actually add, right? So yeah, it added more wins, but our returns decreased. All right, so that's right now from a historical perspective what these analytics are showing you to help you make that decision, right? So I can't tell you the best one. What it's doing is showing you the data and the analytics, because at the end of the day, it has to be what the best is for you, what you're looking for. But this is information to help you make that more informed decision, right? Because what's best for you might be different what's best for the next person and the next person, right? But the idea there is to help you make those more informed decisions, right? Because there you have it. You have different choices. You could have different outlook on the stock. You could have a different time horizon. You could have, some people, have a bigger tolerance for volatility. Some have a lower tolerance for volatility. So all that comes into play. But these are the stats here to help you out, again, to make more informed decisions.
Well, that was an awesome analysis, D, and walkthrough. And that was who was that new Chameleon who came in? That was Fred who asked that question. So Fred, thanks for the question.
Yep. Thank you, Fred.
Hopefully that helped. If you have a follow-up, put it in the chat or email support@MarketChameleon.com. We also had a new user on, Sandra, who came in and she was asking, and maybe we can do this tomorrow, is there a way to screen for stocks in an uptrend? So why don't we leave it there, because we're right at the opening bell. We'll look at that tomorrow. Thanks. And yep. Sandra's a new Market Chameleon as well. Thanks for joining, Sandra. And thanks for everyone for coming in and asking the questions. It makes for a great show. Actually, Fred at the end just said, excellent job. Thanks, D.
Oh, thank you.
That's great. Thank you,
Fred. For the question, for sure.
All right. Great job, buddy. See you later today.
Yep. Stay safe out there, everyone. Have a great trading day.